Welcome to this special edition of the Connecting to Reimagine webinar. This is the 10-year anniversary of GFLEC, and we want to dedicate this webinar to one of the activities that we do the most at GFLEC and we care very much about, which is research on financial literacy. And to do so, we have asked the collaboration and participation of three very important researchers, which have done an amazing amount of work and research on many important topics, as you will hear today, but have also converged on studying financial literacy. And I'm particularly lucky to say that they have collaborated a lot with GFLEC. So thank to all of you, Pierre-Carl, Lukas, and Leora, for being here today. And let me start actually with Pierre-Carl, who has done a lot of work on savings, pensions, and also has done a lot of theoretical work, studying how people make financial decisions, I would say in a very rigorous way. So Pierre-Carl, we have also done research together looking at financial literacy and adding financial literacy into traditional model of savings. This research has been published in the Journal of Political Economy. And I would like you to describe that project, perhaps to put it in a perspective so we can also understand what it says better and also to think a little bit about how we can use it more in the future.
Sure, Annamaria, if you remember, we started off that project a number of years ago with Olivia Mitchell, and really the starting point was the vast heterogeneity in wealth accumulated at retirement. So wealth inequality, not necessarily of the very rich, but of the general population. And we were seeing that shift to defined contribution at the time, more responsibility with deregulation towards the consumer for making financial decisions, in particular regarding saving. And your research with Olivia had shown that financial literacy was potentially very important, associated with saving with a number of financial decisions. So the idea was to put all of this together and try and think of financial literacy jointly with the observed facts in terms of wealth inequality. And I think the first striking point we started on was the distinction between how much people save and how much that leads to differences in retirement wealth, and how much productive people are with saving, meaning how they invest and how they get different returns over the life cycle, and the role that played potentially in retirement saving. And that's where financial literacy came in, realizing, and research was starting to emerge, that people with higher financial literacy were doing better for a given amount of saving, were being more productive in a very crude economic sense with their saving. And so this has potential implications which are important. At the time, before we wrote that paper, the workhorse economic model of life cycle saving, and that is sort of our theory for thinking about these things, assume that beyond portfolio choice in terms of stock market participation, people were getting the same returns on their retirement saving. And so those models had a hard time explaining why wealth inequality had increased, and in particular with the trends we were observing. And that's where we started thinking about how do we build in financial literacy into that workhorse model. And I think a key point was that it was unsatisfactory to simply say that different people had different productivity with their saving, or were doing better than others. And we wanted to model as well, why do people actually acquire financial literacy? Financial literacy is not a fixed skill, and you had emphasized that in your research. And so very much in the human capital tradition, we built a model where, and the basic reasoning is the following: someone who has to save a lot for retirement has a larger incentive to actually learn how to be productive with its savings, so acquire better rates of return. And so people with a higher need for saving will acquire more financial knowledge, and people who say have a very generous retirement package may not need to learn about very complex financial products for retirement. And so once you build that in the standard model, basically you can generate a lot more wealth inequality, and basically the headline finding from that paper was that up to 40% of retirement wealth heterogeneity could be explained by this mechanism. And so that had some impact on, in terms of the research. One key point I think that stays is that really financial literacy and saving or other financial decision is a two-way relationship. We really ought to think about it in terms of, the effect of financial literacy on personal finance outcomes, but as well, the opposite is also true. And we need to think rigorously about that. And of course, if you want to talk about that, it also had implications for financial education, and we can touch on that later.
Thank you very much. And I'm going to turn to Leora because, we needed this measure of financial literacy, of course, to do the research. And I have to say, with your extraordinary help, we have been able to add questions to a survey which is now available and provides data on financial literacy in as many as 140 countries. So, now, in fact, we have measure of financial literacy everywhere. And I have to say that data set, the global FinLit survey, is still the most cited data set and the most used data set when looking at financial literacy, because it's still the only global one. So Leora, I'm going to turn to you also because you have done this incredible project also to measure not just financial literacy, but also financial inclusions, and tell us a little bit more about that project and in the way in which it is important for financial literacy.
Thanks, Anna, and congratulations on the GFLEC anniversary. So financial inclusion has become a major topic in global development. So it's hard to believe that in 2011, there was no single data source with nationally representative, comparable global financial inclusion indicators. And the Findex database provided the first such data. It's evolved in tandem with the financial system. In 2011, we had a question about paper checks, but nothing about mobile money. That only came in 2014. And so the Global Findex provided the first global snapshot of the unbanked, the way people use their accounts. And importantly, it's revealed opportunities to increase account ownership and the use of accounts for savings, payments, and appropriate credit. If I had to sum it up in one sentence, I'd say the world has seen plenty of progress on financial inclusion over the years. There's still a long way to go. And the Global Findex started with a simple question: how many people have financial services? But it's not enough to answer that question. It's also important to consider whether people are able to safely and effectively use these financial services to meet their needs. And that's why we added the 2014 financial literacy module. The findings were striking. Globally, only about 1 in 3 adults demonstrated knowledge of financial concepts, including very simple conceptual questions on inflation, interest rate compounding, and discounting. And our global indicators were published, as you mentioned, in Financial Management Journal, and remain the most cited data on financial literacy. The paper also discusses how relatively low financial literacy levels really exacerbate consumer and financial market risks as increasingly complex financial instruments are entering the market. So credit products, many of which carry very high interest rates and complex terms and conditions, are becoming more readily available, especially to lower income and perhaps lower educated, less financially savvy customers. Yet only about half of adults in BRIC countries, developing countries, who use a credit card or borrow from a financial institution are financially literate. Even among adults in the United States who have a housing loan, which is typically a more complex financial instrument, only 30% of these borrowers can answer questions on basic interest rate calculations on these loan payments. This all highlights the importance of also targeting financial education to the moments when people need it most, such as when applying for a loan, and the policies to protect borrowers against risks, including greater lender transparency and easier to understand ADR and loan terms.
Thank you so much. So, Lukas, I'm going to turn to you because we have data on financial literacy now, and we can see that it is correlated indeed with a variety of indicators, including financial inclusion. The theoretical models do indicate that financial literacy can have a big effect. It can explain as much as 40% of wealth inequality. So it seems that financial literacy does matter, but does it really? I know that you have done a lot of work of studying financial education in schools, and then more recently, we worked together on a meta-analysis because some of the earlier meta-analyses had indicated that financial education didn't seem to work that much, and so but those studies are now outdated, and so much more has been done. So maybe tell us more in particular about the meta-analysis, which I'm happy to say that is now forthcoming in the Journal of Financial Economics.
Thank you, Anna, for your kind introduction. I'm glad to say a little bit more about our joint work, which is also in cooperation with Tim Kaiser and Carly Urban. So what we did, we started some years ago, more than 3 years ago, actually, and our ambition was to collect a full set of all RCTs, randomized controlled studies that have been done on financial education all over the world. And we found 76 of them. And in many of these studies, you have a lot of estimates of financial education impact. So we collected, in this case, more than 600 of such estimates. And this is, so to speak, the databases that we analyzed. And I mean, it's a long paper with a lot of results. I would like to highlight just 3 of them. And most important, I think, is that we can overcome the often ambiguous results of earlier literature and find very clearly that there's a positive causal treatment effect of financial education, as well as on financial literacy and on financial behavior. I think what is also important is to highlight the question whether this is large or small. So what is the impact? And what we find is, what we can say is that the impact is comparable to what you find in general in the education literature. So whether you educate on mathematics or whatever, or on financial literacy, the impact of education is quite similar in size. So it's worthwhile from that perspective. And the third highlight I would like to mention is that we know from the literature that we often find publication biases, and these publication biases tend to overestimate results. So it's often an objection against financial education literature that people claim that it may be overestimating the true effectiveness. And we indeed also find publication bias. That's to be expected, because studies who find something interesting to report are more often published than boring studies finding nothing. But even correcting for this, we can still say the impact of financial education is there. It's positive, it's significant, and it's also sizable. So these are some of the main insights from this joint work.
Thank you very much. And I'm going to come back to you, Pierre-Carl, because doing an evaluation of the effectiveness of financial education is very hard. And I think sometimes we forgot about the theory, right? We forgot about the fact that, it's not that because you do education, everybody should change behavior, and the theory is, of course, very clear about it, but, sometimes perhaps we don't consider that enough. So I want to come back to you and say, but what do the theoretical models that incorporate financial literacy say about, for example, evaluating the effectiveness of financial education?
So that's a good question, Annamaria. So think of someone who receives an invitation to participate in, a program, a financial education program. There are benefits and costs to doing it, and the benefits, could be that his or her financial literacy will increase, and potentially there could be benefit in terms of either saving, debt management, or other outcomes. And so the first key point is that, well, if you target randomly in the population and you ask people to participate, not everyone is going to want to participate. There are people for whom either the cost is too high, or the benefit is low. And you can think of financial education as reducing the cost of acquiring financial literacy. So full participation is not optimal, and also change in behavior, you know, it depends on individuals. There's some individuals for whom behavior was already optimal, and then so they do not need, for example, to save more, and so will not save more if you force them to sit in a program that tells them they should save more. And so that's one key takeaway. Second key takeaway is that success needs to be defined carefully. Again, taking the saving example, if you define success as raising the saving of everyone in a group that is following a financial education program, you need to ask yourself whether that's in people's best interests. And so thinking hard about the theory, thinking hard about what people should do helps you define success in a better way. And I guess the last point on which probably Lukas is going to agree, that ideally you want to randomize the treatment assignment, the eligibility to the program, because again, people who participate in programs are different than people who don't, and you want to account for that in some way, and randomization is our best way of doing that in science in general.
Thank you very much. Leora, I'm going to come back to you to talk about a topic we are both very passionate about when we speak of financial literacy, which is gender differences in financial literacy. And it was extraordinary to see that in the global survey, there is basically a gender difference everywhere. So I would like to come back to you and, can you talk more about this topic? I know you have done, fantastic research on that, and maybe with also an indication of, what could be the causes of that, or potentially what could we do?
Sure. So one of the things I'm most proud about with the Findex database is that it's the first global data on women's personal financial ownership, account ownership. And it's really been very powerful and impactful in allowing policymakers to identify the gaps between men and women and track progress over time. As I mentioned earlier, the world's made a lot of progress on financial inclusion, but the gender gap is a huge caveat to that. Hundreds of millions of women have opened accounts since we started collecting the global Findex data in 2011. But the problem is that they're not opening them fast enough to reach equality with men. So men are still 7 percentage points more likely than women to have an account, and that gap hasn't changed in the decade that we've been doing this. And so some countries have made progress, but others haven't. In some countries, for example, men have adopted technology-enabled mobile money and bank accounts, but women are being left behind, often because of the gap in digital inclusion and phone ownership. So on balance, we're not where we need to be. We also find that women trail men in financial literacy. Interestingly to me, women are also significantly more likely than men to reply, "I don't know," to the financial literacy questions that we ask them. So they can answer yes, no, or simply, "I don't know." And so in other words, not only are a woman's knowledge of financial concepts lower than men, they also have less confidence in their knowledge, which likely spills over to their confidence in making financial decisions for themselves. And so regarding what to do, my research is focused on the importance of both financial education and financial experience. And so there's growing evidence from government payment recipients in Mexico, garment workers in Bangladesh, new work I'm doing with low-income migrant workers in Korea, that people develop the confidence to use financial services, both by receiving education and also by using them over time. And that people are more likely to learn financial skills if you also provide training at the time they really need it. So my experience in Bangladesh, for example, bears this out. We did a study on digital wage payments for garment workers. And so most of them had very low educational attainment, literacy and numeracy at the baseline, and they were not financial experts by any stretch. And so we gave them simple, basic training on how to use digital wage payments before the experiment began. So they'd be ready when the switch from cash happened. And the results were really positive. They learned to manage their risks better, they increased their savings, and they didn't want to go back to cash payments. And I doubt that would have happened without both the basic training and the ongoing educational support that was provided. Some more general recommendations to increase both financial inclusions and literacy is both to encourage greater usage of accounts paired with greater tailored financial education. So for example, banks should hire women. There's evidence that women are more comfortable transacting as an agent of their own vendor. Banks should be encouraged to report gender disaggregated data on client-facing staff. And women often don't have the tools they need to get financial services like official identification and mobile phones. So increasing access to these tools will indirectly help with financial services. Phones are also a great mode to provide financial education, especially at these teachable moments.
Thank you very much. And Lukas, we already have questions about your work, so I'm going to start with that. So maybe you can also mention that as well, which is, what are the outcomes that we look at in our meta-analysis, so that people know about the behavior. If you can briefly mention this, but then I'm going to ask you, you have done this important work in financial education in the schools in particular. So really looking at, I think, what is a very important topic that we are all looking at, in particular after this pandemic. So can you also talk, for example, I know this is research with Tim Kaiser about the financial education for young people done in the schools.
Yes, of course. Just the outcome areas that you mentioned in the meta-analysis, there are 5 outcome areas, and the most important ones are savings and borrowing, and of course planning and budgeting and things like this. So coming to this meta-analysis on schools, I have to say that in that study, we also cover quasi-experiments. And the reason is that we don't have very many RCTs on schools. So it's in any case, it's always a problem with these kind of studies that we have so few observations given the heterogeneity of the subject. So actually we would like to have hundreds of studies about schools, but in the end we have 18 RCTs, or we had 18 RCTs at that point in time, and another 20 quasi-experiments. So the findings are very similar to the general meta-study. I think that's interesting because much of financial education is done in schools, and we find that it seems to work to a similar extent as it does with adults. And another finding which may be comforting is that when we try to break this down into levels of schools, so starting with elementary school, middle school, and high school, I mean, it's a lot of insecurity about the estimations, but still what we find is when looking at the point estimates and some of the estimations, confidence intervals, what we find is that it seems to work at all levels of age actually, which is interesting. Of course, the subject cannot be the same. You cannot teach the 6-year-olds the same as the 16-year-olds, but still we find if it's adjusted to the age, it seems to work to some extent.
Thank you very much. I'm eager to come to the title of the topic today. So we set the ground, but we also want to talk about the future. So Pierre-Carl, as we look into the future, given the extraordinary research that you have done, including the one on financial literacy, what are some of the topics that you see are important? What do you see, looking at the future and also the development of this field?
Well, we need to learn more about what works and what doesn't in financial education. So more field RCTs to add observations to your meta-analysis and improve our understanding of exactly what works. I think a closer link between theory and empirics, because again, very often success is difficult to define, in particular intervention domains. So I think that can help a lot. And finally, I'd add that I think we need to look a little bit more at the interplay between preferences and financial education, things like present bias, things like framing effects, and so on, and really sort of link this literature on nudges and other choice architecture interventions with what we're doing here in financial education. What is the intersection between these two fields? I think, I'm following the work of many people. I'm very excited about what everyone's doing, but I see this as a future area for growth.
Thank you very much. And, Leora, you have such a position also because you are at the World Bank, your work has been so global and so important. And, and now we are in this pandemic and try to recover from this pandemic. And I'm sure, countries will do it differently. So, how do you see the research about the future and, the shaping this field into the future? What are your insights and your recommendations?
So it's certainly a tremendous opportunity now to identify the gaps in financial education. So for example, there's a big opportunity to evaluate pandemic responses. Dozens of low-income countries have used some type of digital payments using the formal financial system to provide cash relief to citizens. And millions of women in developing countries have received wage payments into an account for the first time, as it became unsafe for people to travel and stand online, and cash was perceived as unsanitary. Hopefully people will be able to effectively use these payments to meet their digital payments, to meet their needs, to keep the money electronic for savings and for payments. And hopefully they'll graduate from passively receiving these digital payments to actively using their accounts for additional purposes. All of that remains to be seen, and there hasn't been much new research yet of how we can encourage greater and more efficient usage of accounts. Consumer protections are also an important dimension of the financial literacy conversation. People only use financial services if they trust them, and consumer safeguards help banks earn that trust. So consumer protection is especially relevant now, with so many previously unbanked adults using financial services for the first time. So IPA has done surveys in a few countries. And so, for example, in Nigeria and Kenya, they found that most digital finance users had encountered some type of attempted fraud since the pandemic began. And I would certainly say that it's time to update our global financial literacy indicators, which were collected in 2014. We're very excited. We're collecting the latest new round of global Findex data over the 2021 calendar year. They'll be published in June 2022. In addition to updating our indicators, we've added a large number of new indicators on digital payment adoption during COVID, asking people if they received their first electronic government transfer, wage payment, paid a utility bill for the first time electronically during COVID. And as well as we've expanded our module on financial well-being and on financial worry. A very nice panel that we collected data in association with the Gallup World Poll Survey. And Gallup's been collecting for some time in the US a question, effectively, what keeps people up at night? Is it meeting their short-term monthly expenses, worrying about retirement for a health emergency, school fees? And so we're asking this globally, understand across countries, what is people's greatest financial worry, and how can we design both the financial products, but also the financial education and support for people to improve people's lives?
Yes, what is very important and amazing is it's really a global issue. And I think studying it globally can add a lot more to this topic. And I'm going to ask the same question to you, Lukas. What do you see the future directions of research for this field? And what do you think it is important to study, particularly now and looking at the future?
In general, I would agree with my predecessors and would say there are a lot of areas. And as I'm an empirical economist, let me highlight a little bit more how little we know today and how much room there is for additional research. So in our meta-analysis, we are just covering 33 countries, and there may be just a handful of countries where we have a number of RCTs. So most of the world is unstudied in that respect. Coming to target groups, think about we are covering children, we are covering adults, we're covering them at different places. Difficult to compare and difficult to expect, or not very likely to expect, that all the same measures apply to all these different target groups. Coming to topics, I mean, we just mentioned we have covered in the meta study 5 topic areas, and one of these areas, borrowing behavior, for example, we have high heterogeneity across studies, and we are not quite sure which elements of financial education are important to make it work. And then finally, approaches. There are so different ways to teach or to educate people, and which of these approaches are very effective, and which one do we need in which country, for which target group, under which circumstances. So you can imagine there's room for hundreds and thousands of works to come in the future to find out more what we should do exactly under which circumstances. So, I mean, everybody has its own preferences, but I think from an empirical point of view, I would like to highlight how much has to be done to really create most effective financial education.
Thank you very much. And, this is, I think, what is so important for this field, right? We need to address these important questions, how can we help design policy and programs? And I just will turn very quickly to questions because there are so many of them coming in. And so I also like to invite our participant to put in the questions, but I would like to each give you a final round to actually ask precisely these questions. And I'm going to start with Pierre-Carl because he is also a member of the OECD INFE Research Committee. So what are some of the implications of the research you have done and you have seen on this topic for policy and programs and also for the private sector?
So when you talk to policymakers, clearly the perception has changed. At the origin, I think there was some suspicion, to be honest, about financial literacy generally and financial education. I think that perception has changed based in large part, due to the work of your center and its research community. That perception to the effect that rigorous work is being done in that domain and that financial education can work, helps policymaker sort of balance, between regulation and education and try and achieve, their objectives. And to me, the change in perception is a very slow process, and we need to continue working on that. And and that's going to be very important going forward.
And Leora, I turn to you, in particular in your important work at the World Bank. What are some of the implications of your research for policy programs, the public and the private sector?
So there's no one denying the importance of financial education for the safe and effective use of financial services, especially with the goal and the work at the World Bank to expanding inclusive access to financial services. I'd say, the future of some exciting research is better understanding of the various modes of delivering education. The strengths and weaknesses and challenges of providing in the classroom, providing at points of contact, leveraging all sorts of new technology from text messaging to social media, and also the importance, as I mentioned earlier, around the teachable moments of how can we most effectively, get information about remittance prices to migrants at the point when they move overseas, to workers at the point when their wages are being digitized. And so taking together effective and ongoing financial education can both help people more safely and responsibly use their financial services, as well as more effectively use them to save for their future goals.
Thank you very much. And I'm turning now to you, Lukas, with the same questions. If you had to take the finding from your research, which has looked at so many, in particular, these very rigorous evaluations, what are your recommendations for policy and programs?
And the most important consequence I see from our research, which I try to sell to policymakers or practitioners, is that they invest more in rigorous evaluations, because from the experience, at least, that I have in Germany or Europe, I see that there are so many programs which are not really evaluated. And many seem to be afraid of the results instead of seeing it from a positive point of view, that they can learn something, how to improve the programs in the future. And if we would have more of these rigorous evaluations, it would be much better for us and easier to find out exactly how policy must be designed to be most effective. I mean, I do not question that financial education works, but the question is, we are investing a lot of money into that area. So how should we do it exactly? And to answer that question, it would be good to have more data, more information, more evidence-based policy. And this is my major recommendation in that area.
Thank you very much. I'm going to turn now to the questions. So I see a list here, and I'm going to try to combine them as well. So, we'll be able to answer many of them. The first one is, again, to do with the fact that, this is such a complicated world. now there are cryptocurrencies. So are we asking people to become CFA? And I'm going to start maybe asking this question to Pierre-Carl.
The key issue is you need to learn what is most likely to be important in your domain. For some people, it's going to be debt management. For other people, it's going to be, saving, and so that would be the short answer.
Thank you. There are a set of questions which now I'm going to turn to Leora in particularly, and then Lukas, you might have answer for this as well, which now of course makes the point, look, if we look at people which are in poverty, dire poverty, which do not have a good income, they don't have a stable source of income, they are facing all kinds of challenges. And also, they might be in area where there is predatory lending and so on. So, financial education in these cases, probably is not the things to do, or it might not even work. What can we say about that?
First, I would add that I don't think the goal of financial education is to put the onus completely on that of the consumer. The financial service providers also have a responsibility. Their responsibility to ensure that their agents aren't taking advantage or offering of potential and existing customers, to make sure that customers are being offered appropriate and the best product for their needs. And that's, and that requires a strong and enforced consumer protection framework in association with collaboration with financial education. But yeah, I agree. I mean, and again, it's meeting people where they are. Certainly, for example, when we talk about government transfer payments, the goal isn't necessarily long-term savings. Most of that money is needed for necessities. However, how can we encourage people, A, to withdraw the money without having to pay, additional informal fees, for example, which are sometimes charged by agents? How can we encourage the recipients understand that if they keep their money electronically, it might be safer, especially from borrowing from family and friends or from crime? And how can we encourage them to understand the value potentially of using the money electronically to make payments? Not only payments in developing countries are far more than a convenience. Digital payments, workers often garnish their wages to run around town paying bills, and so empowering people, including poor adults, low-income workers, on the potential of formal financial services can help even low-income communities.
I'm going to turn to you, Lukas, now to questions that I'm sure you have considered, which is how can we evaluate the long-term effect of putting financial education, but in primary and secondary schools? How can we be sure it works in the long run?
So to be honest, unfortunately, we cannot be sure currently, because we have only very few studies covering behavior or covering people or following people over many years of time. But when we have a few studies who do this, and taking these studies, we can at least say that there remains some impacts of education. So it doesn't look like that people forget everything, or whenever they change behavior in somehow their desired direction, they would rechange it again. So this is not true. It looks like that they keep to things they have learned, at least to some extent. So that is the good news. But to be honest, I mean, there is no long-term study that I would be aware of that you could say, okay, we teach people something at school, and then we look how they behave 20 years later. I think that's not there. So the maximum horizon currently is something like 3, 5, in very rare cases, maybe a little bit longer. Yes.
There are several questions here related to this topic of incorporating and trying to incorporate both in this optimal level of financial literacy, but also in decision-making, the psychological aspect, the emotional aspect of talking about money that, of course, a lot of behavioral economists have also mentioned, and also biases that people might have. So what can you say about this? I'm going to turn to you, Pierre-Carl, but also ask other people if they want to comment.
So very often we have very little knowledge about the underlying causes of these biases, or of these psychological traits, how they vary across people. And so I think something that is interesting to study is how financial literacy can help potentially lower some of those. So think about inertia, or status quo bias is often driven by, the fact that you ignore a little bit how to evaluate something or how to look at something. So you prefer the default of not buying it. And obviously, financial literacy there can help and, could potentially reduce, for example, that type of bias. So I think it's very, the other domain where I think it's very interesting to study financial literacy is in the case of defaults or nudges, which is to say very often nowadays we make someone participate, for example, in a retirement plan by default. And for the nudge to be superior to a pure mandatory program where you force everyone to participate, well, then in the nudge you can always opt out of the program and decide to leave it. But in order to leave it, you need to have some level of financial literacy to decide that this program is not for you. So nudges, to some extent, can be superior to other types of interventions, but very often one of the prerequisites is that people have some minimum level of financial literacy so that they can effectively opt out of these programs. And so all these interactions are very interesting to study.
I'm going to turn instead this question to you, Leora, because I think it's something that you actually have done. How can we develop strategies and financial products, at the national and supply level, that integrate important financial well-being aspects, such as building resilience, particularly during the current crisis? Do you have some idea on how we can do that?
So, yeah, I always say you can't solve a problem that you don't measure. So certainly the new financial resilience questions that we're collecting over this calendar year as part of the Findex database will hopefully shed light on the question across country. So we asked the question, could you come up in an emergency with about 5% of GDP per capita, about $1,600 in the US? And we ask it on 2 time horizons, within 7 days, so effectively now, and over 30 days. And there's really wide, and then we ask what would be the main source of this money. And then most importantly, we ask how realistically is it that you could come up with this money? Because a lot of people say, oh, I'll work more gigs. And then when we ask them, how realistic is it that you could? They say, oh, very unrealistic. So we'll have a good snapshot of just how vulnerable people are. And we really saw that at the outset of COVID, when during lockdowns, when people's income fell. There's been very good work being done by in the UK looking at household balance sheets that finds that most adults this is for a sample of high-income countries, don't have more than 60 days of liquid assets to support themselves with. I think more information, collecting additional study into households' balance sheets, especially on their asset side, would be very valuable to identify those gaps. In terms of with the global Findex data, it's really important also to see what people consider a reliable source. In 2017 Findex, for example, we found that about 20% of women in Pakistan said, if I have a health emergency, I'm going to use my savings. And then we asked them, well, where do you save? It's under the mattress, or it may not be when an emergency hits. And so, there's 2 stages of building resilience, of improving people's resilience. One is just, making sure people understand that the unexpected can happen. The importance of having that buffer in case of an income shock or a health crisis. And then secondly, quite importantly, is the next step of encouraging people to save their money and build resilience in formal modes of savings and in safe ways.
Continuing on this point, and I have a question for you, Lukas, from somebody who's doing, for example, financial education for adults, but in rural areas, right, where it might actually be difficult to do it, and the financial education is very low. And so he says, unlike students who could be given training at a younger age, any suggestion on how to give effective financial education to adults, especially female, in rural region with increasing level of financial inclusions. I know you have done some of the work on that. I don't know if you have research that does it, and also if you have any insight on digital financial literacy.
So we have indeed done some work in rural areas in developing countries, and typically it's done indeed by trainers who are traveling around, and so that means they give seminars, and I mean, you cannot do teaching like in a big city where you have a course every 3 days or something like this. So probably it's more just some hours. Digital financial education is of course an interesting and important topic, but I think many countries are lagging behind in that respect. And I know more from central banks in developed countries who have developed a set of tools, are continuously developing this set of tools. But I think in many areas of the world, it's difficult, and think about that it's not so easy to receive these kind of information. So if you really think about poor rural areas, people don't have smartphones, for example. So you come to technical limitations then, sorry.
Yeah. Thank you very much. Unfortunately, we have come to our end of this webinar, and I want to thank, first of all, these 3 extraordinary speakers today. And I also want to add a small comment about research and to the researcher. And this is really encouraging words. I have to say, as a researcher who was working in this field, it is possible not only to publish in financial literacy in this field, even though it's a new topic, but it's also possible to publish in top journals, and it's possible to publish in Fields Journal. And when you do so, you can even be given prizes. So I'm very proud that we have published paper in the Journal of Political Economy, in the Journal of Financial Economics. We have gotten a prize for our paper in financial management, just to mention some of the publications. And also I've seen that often the papers on financial literacy are the most downloaded and the most cited. So as a word of encouragement for all of the researchers listening to us today, to embrace this field also, because we really need to know more. And your research can be very important and very impactful. It can certainly, for example, influence what policymakers are doing in this moment as we try to get out of this pandemic. And in particular, they can make a difference in people's life. So I want to end with the statement that, if there is a question, does financial literacy matters? I think the answer to that question is a clear yes. Thank you very much to all of you, and till soon to the next webinar, and happy birthday to G. Fleck, who is now 10 years old. Thank you again.